Markets have been choppy lately, and this is the perfect time to average into those high quality growth stocks. And we are going to look at anything that's trading below their value that is going to set us up for the long term potential here. So, in this video, I'm going to go through three stocks that I am buying or looking to buy currently. And those stocks are going to be Amazon, Adobe, and Salesforce, and why I think they are set up to have a strong run in 2025. As always, this is not financial advice, and make sure that you guys are choosing your own stocks, doing your own due diligence, and making sure that you guys are doing all your research before buying. Let's get straight into the video. Now, we are in an interesting phase in the market where inflation is cooling, interest rates are finally starting to come back down, and that means that investors will be rotating back into high quality tech and software names. Now, the three stocks that I mentioned, I'll talk about how they have such strong free cash flows, pricing power, and have proven business models that are going to thrive once growth does come back. Now, the first stock is Amazon, trading at $224 today. And looking at their portfolio of revenue segments, you can see that everything across the board is growing. Third-party sellers, online stores, AWS, advertising, subscriptions, you name it. This company is growing delightfully. AWS growth is reaccelerating after that little slowdown that we had. But nonetheless, AWS, we found out just how important AWS is to the entire world. It shut down nearly 50% of businesses when an AWS had a crash, a shutdown for a day. So the entire world pretty much runs off AWS, if not majority of it. So this is super exciting for us to see. E-commerce, this online stores, they have grown this exponentially. Now, Amazon isn't just an e-commerce company anymore. It's a cloud logistics, advertising powerhouse. AWS could alone just justify the current valuation, and ad revenue is quietly compounding at about 20% every single year. With rates likely to ease next year, I think Amazon's margins and multiples have extreme room to run and expand again. Now, Amazon is a company that's growing their top line at about 10 or 11% every single year, and their bottom line, their net income, they're growing that at about 58% every year over year. Now, this is an interesting one to look at because a lot of the times you'll look at free cash flows and how are free cash flows, generated when it comes to a powerhouse like Amazon. You'll see that free cash flows have actually dropped year over year. This is mainly due to the amount of investment that they have into the business again. Now, that is going back into their cloud computing, their infrastructure, just to throw it back so we can grow this business. We can see that in the past trailing 12 months, they have invested about $107 billion into capital expenditures. This is just going to be money that is going to be thrown back into the business. Now, something to really look at is operating cash flow. Operating cash flow here is increasing 12% year over year. That's actually how the business is going to be efficient regardless of capital expenditures. So their operating cash flows are still growing at about 12% every single year. And that has slowed down a little bit, but nonetheless, it is still growing. Now, on a valuation basis, this company trades at about 32 forward PE. And this company is having returns on invested capital of about 10%. So we can really expect the company to keep growing 10% year over year, and it's Amazon. You are getting a very great company at a fair, reasonable price. I would say this company is actually trading not too expensive. It usually trades very, very expensive. So if you look at operating cash flows and you see like the price of operating cash flow, this company is actually around about 19 and a half. It usually trades anywhere between 18 to 19, but I think this company, if you hold it for the next 5 or 10 years, I truly think if I hold it for the next 5 or 10 years, then you will come out ahead. This company should generate about 10% every single year, and you're getting a very great company that's built out already, run by Andy Jassy. A lot of people don't like Andy Jassy, and I think in his earnings calls, he does need to step it up a little bit more. But nonetheless, it is a company run by Andy Jassy and Amazon team behind it. It is a company with an extremely wide moat that if you were to go out there and look at every subscription that you have, you'll probably find that Amazon is one of them. If not like Twitch or Prime Video or just all the things that come with Prime, you will probably be spending money on. And AWS, every single website that you probably go on is likely hosted by AWS. So there is a extreme need for Amazon in this world. Their price to earnings, this is actually a little bit cheaper than where it usually trades at. It's usually anywhere between like a 40 to 50 PE. Right now you're getting it at a 33. This is a discount to where the stock usually trades at. So I think buying Amazon today, you will be okay. I think that I'll be okay buying the stock. I'm not saying go out there buy Amazon. Of course, do your own research. But I truly think that Amazon's moat is one of the most impenetrable. And as for Amazon, I've been trying to load up lately. I know they announced earnings in the beginning of November. So this is my time to kind of look at the stock and say, do I have enough before earnings come in? Because if they do beat earnings and it does shoot up to, let's say like 230, 240, do I still want to like buy then? I probably still do want to buy if you look at the long term, but today, am I getting a deal? The answer is yes. So I've been averaging into Amazon over the past couple of weeks to try to build out a position before earnings. If it does drop, load up the boat. I'll be loading up the boat. That's what I'll be doing, because you're having a world-class company, top of the line, that is generating 10%, 30% earnings, and this is going to be a company that I think I'll regret if I do not own. So Amazon, definitely one of those ones that I do want to buy. Now, the next company here is Adobe, ADBE. This is a company that has been dropping ever so slightly from $600 in the past year all the way down to $350. It's been very intriguing for a lot of investors. You are looking at a company that is 147 billion market cap and trading at a PE of 22. If you look at a forward basis, this company is trading at a 15. So if you look at just where it is on a valuation basis, it looks extremely cheap. But how does growth compare? You are looking at a company that is growing top line at about 10% and bottom line at about 29%. That is a extreme grower for paying a 15 forward PE. This has caught my eye recently, that this looks like a company that is generating cash hand over fist. If you look at just their returns on invested capital here, returns on invested capital of about 27%. That is a lot of money. Usually anything above 20 is very, very good. You want to see your company that you're invested in get that return on the money that they throw back into the business. Here, they're getting 27%. Now, looking at the moat of Adobe, a lot of people are against Adobe and buying the stock because, one, you have OpenAI Sora, you have Google Gemini getting into the space now. And is this going to disrupt Adobe? You have a lot of AI features, a lot of AI platforms coming into the market. You have startups coming in and taking away potential market share. Will this affect Adobe? I would say yes, but not to the extent that most people think. I think Adobe has a moat at the end of the day. You could see that in every single lever, like digital media, they're growing 11%. Digital experience, they're growing 9%. Purchasing and advertising, this has calmed down a little bit, but it's very, very small. This is $260 million versus a $21 billion here. So just their creative alone is growing 12%. Their document cloud is growing 24%. In America, they're growing 10%. In other parts of the world, they're growing 14 and 6% respectively. Nonetheless, it is a company that is growing hand over fist. Will this company lose revenue in the future? I don't think so. I think there is a moat that comes with Adobe. I believe I read somewhere that Adobe has about 58% market share when it comes to their core products. And that is an extreme amount of market share that they hold. If you were to look at all other listings of jobs for, let's say, graphic designers or UX people, then you will see that there is going to be a requirement, and majority of those requirements are must be proficient in Adobe Suite, must be proficient in Photoshop, Premiere Pro, Lightroom, all of those platforms that Adobe hosts. So I believe that Adobe has become the industry standard that people aren't going to shift away too much from. Of course, there's going to be new features added out there like OpenAI, Sora, Google Gemini. Yes, those can help supplement the graphic design process, but I think that people that have been in the graphic design industry for so long, it is very, very difficult for a company to say, let's just go switch like that really quickly and let's use an entire new platform. Because one, if you use another platform, so like me, when I'm a YouTuber, I have a editing service that I use, and it's either going to be Adobe Premiere Pro, iMovie, DaVinci Resolve, any free platform out there. If I spend all of my time to learn Adobe Premiere Pro and I go to another platform like DaVinci Resolve, it is going to be very, very different for me to learn and pick up DaVinci Resolve. Of course, you can do probably about the same thing on both platforms. Given that you could do the same thing on both, given your capabilities, it is very difficult to switch one person to another. It is very difficult for one person to learn an entire new platform. You are not going to go out there and switch your platform very easily. It is going to be very difficult for another company to rip you away, especially if you've already learned a platform and if it is the industry standard. That is my total philosophy on investing in Adobe stock. And if you're really scared of Adobe really getting eaten up by AI providers, there is this thing called Adobe Firefly, which is their creative AI solution where you can create images, video, audio, vector graphics. And a lot of people say that Firefly isn't there yet. But given that Adobe has so much money, they are investing very heavily into Firefly. If you look at the Adobe job descriptions, there are about 50 listings for Adobe Firefly. If you look at AI, anything AI generated, they have about 13 pages of AI engineering that is going to be for AI roles here. And each page has about 10 listings. So that is about 130 jobs that they're putting into AI. So I don't think that they are short of growing when it comes to their business. I think if anything, more competition actually helps because it actually tells them, hey, we actually need to improve our product to get people to stick and stay onto the platform. Remember, subscription businesses are extremely sticky. And once you put money every single year into a subscription, or every single month, you're likely to just keep paying it because you've already been accustomed to getting that payment, using that service, and just not switching. So at the end of the day, do I think Adobe's moat is extremely strong? I don't think it's one of the best in the world, but I do think there is a moat here at Adobe. I do think this company is growing hand over fist, and it would be, I don't know, silly of me to not invest in a 15 PE that is growing earnings at about 30%. Given that their gross margin is at 89%, it is extremely high for what it is. A software company like this will keep growing and just having to put money into heads. They don't have to buy inventory. They don't have to use a logistics company. This is a company that is strictly software. So 89% gross margins, operating margins of about 36%. Free cash flow margins of about 41%. These are all very, very healthy. Now, Adobe is one of those companies that I put $11,000 into. It's about 5% of the public portfolio. And I do want to keep adding shares here. If it does stabilize at this price, I do want to keep purchasing shares because one, I think it's undervalued. Two, I don't truly believe in the narrative that AI is going to eat Adobe's lunch. I think they are well equipped to have that competition and be competitive in this workplace. I think that there is going to be a free cash flow generating beast that we have here, and only time will tell. So that's what I will be looking towards, and I'm super excited to own more Adobe. Now, the last company here is Salesforce, or ticker symbol CRM. This stock has actually dropped from $360 all the way down to $250 today. And Salesforce, if not one of the best companies in the world, with the strongest moats in the world, transitioning From growth to profitability, this is like a margin expansion story. You have AI, data integration across all platforms like Einstein 1, and it's deepening its customer lock in. There's a large enterprise base with recurring revenue streams here, strong buybacks, and shareholder focus on Mark Benioff. Now, Salesforce, you have a company that is growing about 8% every single year. Growth has been slowing, which is why you see the stock drop a little bit. And their earnings are still growing at about 18%. Of course, this is still down from the prior year. What has happened with Salesforce? You could see that their free cash flows have actually been about the same year over year. But I do want to draw your attention over here. You do have a company that is growing revenues at about 8%, free cash flows of about 9%, and net income of about 18%. This company usually trades anywhere between a 70 to 40 PE. It is currently at a 36 today. Now, the way that Salesforce generates money is typically through a couple of things. They have services, they have sales, they have platform, financials, marketing and commerce, and professional services. And if you guys have worked in any corporation, you'll probably see that you use Salesforce or the corporation uses Salesforce. It is the number one way for a company to track their sales, to make sure that these leads are actually getting closed, to make sure that here's where we are in the process of having just an amount of progress every single year. Here's how we could track it, right? Without Salesforce, it is very difficult to know where you are in terms of optimization or lead generation or the amount of deals that you're having closed. So this is a way that customers and platform owners can actually track how many people are we getting onto our platform? How many people are we signing on? And how many things have we upsold them? And how much churn have we had? How much customers have left our platform? And this is very, very essential, like to have in a business overall. So I think that Salesforce is one of the greatest moats out there because one, they have about 20% market share in their entire industry, and the closest market share is probably around like 10 to 5%. There are about other companies that play into this too, like Microsoft or Oracle. But I do believe that Salesforce is one of those companies that is going to maintain that market share because one, it's very difficult, again, to switch from Salesforce to any other system. People have already learned Salesforce. People have already used Salesforce before. If there's an executive that it has been using Salesforce his entire life, comes into a company like this, comes into any other company that is using Salesforce, and they want to switch up on him and say, hey, we're going to use another system, he's probably going to fight back and say, why are we switching? Because we're comfortable with Salesforce. It is an industry leader, and that is what we are okay with. That is what the majority of our corporation has learned and will use. And if you guys don't know, there is other revenue segments for Salesforce as well. It's not just their lead generation, sales tracking. It's Slack, it's Tableau, data visualization and messaging. And usually when you're in a company, you either have Microsoft Teams or Slack. Now, this is going to be the two options that you have. And if you are in another corporation where you need to visualize data, you're going to use Tableau or you're going to use Power BI. Those are the main two visualizations that you're going to use. Sometimes you might use Looker, very small player by Google, if you have a Google Suite. But other than that, Tableau, Power BI are the two main biggest for data visualization. And most people actually do like Tableau over Power BI. So there are a lot of things here going for Salesforce, given that they are one of the best enterprise softwares out there for any corporation to own. And if we look at the revenue by segment year over year, their services have grown about 8.5%, sales have grown about 9%, platform and other have grown about 12%, and marketing and commerce have grown about 5%. Now, one of the things that I would be worried about Salesforce is that they have a stock-based compensation program that has been about $3 billion. That is a 14% increase from 2024. They are issuing stock very, very heavily, given like it's candy in Halloween. This is something to watch out for. I don't like that they're issuing so much stock because it's diluting a lot of shareholders, especially $3 billion every single year. But it's also interesting because if you look at their weighted basic shares, they are buying back their shares. This is almost about, I don't know, $20 million of just share buybacks. So I would definitely gauge whether the stock-based compensation is going to keep increasing and diluting shareholders, or if they're going to cool off for a bit and actually stop giving shares to that many employees. Now, given that the stock is trading at $250 and is at a 21 PE, growing at about, I don't know, 8 or 9% top line, with bottom line growing like 20, I just don't know if I want to invest in this company just yet. But this is a company with an extremely wide moat. This is a company that is very sticky, that is 70+% margins, given that they're majority software, free cash flow margin of 31. But other than that, like their return on invested capital isn't the most glorious out there. It does make me want to own the stock. I do want to own the stock, but it definitely depends on where the company is going to be trading at and relative to how much they're going to earn. And I do think that if this company were to drop 230, 220, it would be very, very intriguing for me to get into the stock. We're almost there. We are almost there. But I would have to reevaluate the business entirely again and make sure that Salesforce is going to be a cheap company that is going to generate value for us in the future. Full disclosure, don't have any position in Salesforce, but tracking it to see where it could trade in the next couple of weeks, quarters, if not years. So let's keep an eye out for that. So to recap everything, Amazon, the e-commerce cloud and ad growth is firing up again, and we might see higher highs when this company does report earnings in a week or so. I'm going to be watching out for that, and follow here to make sure that you guys are watching that too. Adobe, this is a creative software king with AI tailwinds, and this is going to be an exciting story to watch. Now that I've invested dollars into Adobe, this is going to be very, very exciting to see where we can bring the business going forward. Given that they generate so much cash and there is a narrative stacking against them that AI is going to take over their entire business model, I just don't believe it. Salesforce, this is going to be a margin expansion story with AI integration. They have AI integration with a lot of players that are going to be utilized for the Salesforce business model. They did make a acquisition in the past couple of months and they are growing at 8%, but given that this company should work towards better margins, I will be tracking to see what the company does in the future. If you found this video helpful, make sure that you hit the like and subscribe button so more people can see it, and comment down below which of these you would buy today. I'll keep replying to all of them and make sure that you guys stick around for the ride. Thank you guys so much. We're growing so much. Make sure that you guys subscribe. Thank you guys so much. Peace out.